Hello students, good morning. Today we are going to study about the cost reconciliation statement. Under the cost reconciliation statement, we compare two accounts. They are financial accounting and cost accounting. Here financial accounting means final account and cost accounting means cost sheet. Some expenses are recorded in both accounts, means financial accounting as well as cost accounting. And some expenses are only recorded in cost accounting. And some expenses are only recorded in financial accounting. While the preparing cost reconciliation statement, we must be careful about these transactions. And some transactions are only recorded in financial accounting also. For the detail, let's go for the computer screen. Cost reconciliation statement. Concept of reconciliation. Cost accounting is prepared according to manufacturing or process companies. Financial account is prepared on the basis of trading or service provider company. Both the process shows the difference profit and loss because they have their own principle and rule. Differences in profit and loss of two accounts should be reconciled. The statement which is prepared to adjust them is called reconciliation statement. It is also called reconciliation of cost and financial account. In a manufacturing company, two accounts are used. They are financial accounting and cost account. They are two different accounting systems that are maintained separately. Profit and loss account is prepared under financial account, but cost sheet is prepared under cost account. Profit and loss account shows the net profit or net loss of the firm by summarizing actual income and expenses for a specified period. These two accounts shows dissimilar profit because financial accounting records actual income and expenses, but cost account record estimate cost. Therefore, preparation of the cost reconciliation statement is essential since two accounts shows dissimilar profits. Dear students, it means there are different rules for the financial accounting and cost accounting. We record financial accounting according to the financial account rule and cost accounting according to the cost sheet rule. They have their own principle and our accounting system. Wherever we find a difference between cost accounting and financial accounting, we should prepare the cost reconciliation statement. Need for reconciliation. The main needs for reconciliation are as follows. Reconciliation helps to check the arithmetic accuracy of both cost and financial account. It helps to find out the reasons for variation in profit. It helps to coordination between cost accounting and financial department. It helps to prepare policies regarding overhead, depreciation, stock valuation, etc. Reasons for differences in profit and loss. The main reasons for differences are transactions are only shown in financial account, transactions are only shown in cost account, transfer from profit, it means transfer to general reserve, transfer to sinking fund, transfer to asset replacement fund, proposed dividend, etc. These transactions are transferred from profit. Transaction recorded only in financial account and a transaction or income are only recorded in financial account. Expenses or charge only recorded in cost accounting. Overcosting or undercosting of overhead. Differences in opening and closing stock. Differences in depreciation charging method. And abnormal loss or gain, etc. These are the main reasons for the difference between cost accounting and financial accounting of the profits. Items or amounts are shown only in financial account. Dear students, there are some transactions which are only recorded in financial account. It means these transactions are not recorded in cost accounting. So they are listed or they are given below. Debited, expenses or loss. These words you will find out according to the financial account. Debited means recorded in debit side. Expenses means recorded in debit side. Loss means recorded in debit side. First of all, try to understand these transactions are only recorded in financial account. That means if you find this transaction on question, you should write down only recorded in financial account. First of all, discount allowed, commission paid, interest on loan, loss on sales of assets, loss on sales of investment, loss by fire, loss by theft, goodwill written off. Not only the goodwill, all the written off transactions are only recorded in financial account, like preliminary expenses written off, trademark written off, and a discount on issue of debenture, provision for bad debts, tax paid or provision for tax dividend paid. These transactions are only recorded in financial account. They are the expenses. Now go for the credit side. In the question you will find out credited, income, profit or gain. Like interest received on investment, dividend received, rent received, discount received, commission received, profit on sales of fixed assets, profit on sales of investment, transfer fee received, bad debts recovered, appreciation on assets. These are the income. If we record on credit side, these are the income. If we record on debit side, these are the expenses. These incomes are only recorded in financial accounting. And there are some transactions which are only recorded in cost accounting. Look here, cost sheet. They are estimated expenses, drawings, rent of warehouse or godown, insurance of warehouse, notional or estimated rent of business owners, salary of owners, notional depreciation on assets which is fully depreciated. These transactions are only recorded in cost sheet and these are the expenses. Method of reconciliation. Reconciliation statement can be prepared in two methods, according to financial account or cost accounting. Both have two methods. They are net profit or net loss. In this way, it is prepared on four ways. They are net profit as per cost accounting, net profit as per financial accounting, net loss as per cost account, and net loss as per financial account. This is the common format. First of all, we should write down net profit as per cost accounting. If there is profit, we should write down on positive figure. If there is net loss, we should write down in negative figure. It is in bracket, it is the loss. Without bracket, it is the profit. Add. Expenses charged in cost accounting but not in financial accounting. Income recorded in financial accounting but not in cost account. Overcharge या absorption of expenses in cost accounting. Undercharge or absorption of expenses in financial account. Undervaluation of closing stock in cost account. Overvaluation of opening stock in cost account. Depreciation overcharge in cost account. These are the main transactions which are added with the add transaction or profit. Less or deducted transaction. Expenses charged in financial account but not in cost account. Income recorded in cost account but not in financial account. Undercharge or absorption of expenses in cost account. overcharge or absorption of expenses in financial account, overvaluation of closing stock in cost account, undervaluation of opening stock in cost account, depreciation undercharge in cost account. These are the main transactions which are deducted in cost reconciliation statement. After calculating, our result may be either positive or negative figure. Negative figure means net loss as per financial accounting, and positive figure means net profit as per financial account. Now go for one illustration. Dolpa Manufacturing Private Limited has net profit as per cost accounting rupees 75,000 on 31st January, but financial accounting shows it's different. On matching data between cost sheet and financial account, following differences are found out. So look here, these data are related to cost accounting and these are related to the cost sheet. These transactions are related to financial account and these are recorded in final account. So opening stock 15,000, 17,000, factory overhead 16,000, 12,000, depreciation 20,000, 25,000, selling expenses 5,000, 8,000, tax paid only recorded in financial account. If there is not any types of the transaction in cost account, it means only recorded in financial account. Closing stock 11,000, 20,000. Interest on investment, it is the income and incomes are only recorded in financial account. Require cost reconciliation statement. Dear students, there is one way to learn this format by heart and other is the shortcut method. I am going to teach you shortcut method in very simple or easy way. Try to understand. If you understand this rule, it is very easy chapter for you. Here net profit is given as per cost accounting. So we write C minus F. C means cost, CA means cost accounting, FA means financial account. If profit is given according to cost account, we should write down C minus F. If profit is given according to the financial account, we should write down F minus C. So look here, opening stock. Opening stock in cost accounting 15,000 and financial accounting 17,000. After deducting 17,000 from 15,000, our answer is minus 2,000. Next, factory overhead 16,000 and 12,000. Look here, factory overhead 16,000 and 12,000. After calculating, our answer is plus 4,000. Depreciation. Under the cost accounting, depreciation is 20,000 and under financial accounting, depreciation is 25,000. After calculating, our answer is minus 5,000. Selling expenses 5,000, 8,000. Look here, selling expenses 5,000, 8,000. After calculating, our answer is minus 3,000. Tax paid. It is only recorded in financial account. In cost accounting, it is 0 and it is only recorded in cost accounting. After calculating, our answer is minus 7,000. Closing stock 11,000, 20,000. Look here, 11,000, 20,000. After calculating, our answer is 9,000. But it is income. Have a patience. I am going to tell you why I have written down but here. In this transaction there is not but in these two transactions there are but. Have a patience. Go for the next transaction. Interest on investment 0 and 12,000. Interest on investment in cost accounting 0 and financial accounting 12,000. After calculating, our answer is minus 12,000 but income. Dear students, these are the expenses. So we write easily. Here minus means it is less, plus means it is added. Once again, our calculation is in minus, so it is less or deducted. Our calculation is in plus, it is added. So it is deducted, it is deducted, it is deducted. But if there are income or recorded in financial account, go for the once again rule. Look here, these are the credit, income or profit transaction. If you find any one transaction which are recorded in credit side of the profit and loss account as well as trading account. Under the trading account, we write on credit side sales and closing stock. They are the credit transaction. So, if you find any one this transaction, we should write down but transaction. It means income. Now go for the question again. Look here, closing stock is recorded on credit side of the trading account. So it is the income. So we write here but. Interest on investment is recorded in credit side of the profit and loss account. So we write here but. If there is but, that means credit transaction or income transaction. If our calculation is in minus, we should write down on plus. That means it is recorded on add item. If our answer is minus, we should write down on add item. If our answer is in plus, we should write down on minus. So, if there are income, we record it on opposite side. Means, if transaction is minus, we record it on plus. If transaction is in plus, we record it in minus. So, these are our tricky rules for the cost reconciliation statement. Now, go for the solution part. Look here, net profit as per cost accounting 75,000 from the question 75,000. Now, 4,000 is add item, 9,000 is add item and 12,000 is add item. There are three transactions which are recorded in add item. So look here, factory overhead overcharge in cost accounting 4,000 from here. Closing stock overcharge in financial accounting 9,000. Look here, closing stock under valuation of cost accounting or over valuation of financial accounting. Generally, we write according to the cost accounting because transaction or profit is given according to the cost accounting. So, closing stock under charge in cost account. Look here, closing stock under valuation of under charge in cost accounting 9,000. Interest on investment only recorded in financial account. Look here, interest on investment only recorded in financial account. After calculating this transaction, our value is 25,000. Now go for the less transaction or deduct transaction. 2,000, 5,000, 3,000, 7,000. These are the deducted transaction. For the 2,000, opening stock under valuation in cost accounting. Look here, opening stock under charge or under valuation in cost accounting 2,000. Now go for the 5,000, depreciation under valuation in cost accounting. Look here, depreciation under valuation in cost accounting 5,000. Depreciation under charge or under valuation in cost accounting 5,000. Next is the 3,000 related to the selling expenses. Selling expenses under charge in cost accounting 3,000. Selling expenses under charge in cost accounting 3,000. Now next is the 7,000 related to tax paid. Tax paid only recorded in financial account 7,000. Look here, tax paid only recorded in financial account 7,000. after calculating these 4 transactions, our balance is 17,000. 75,000 in plus, 25,000 is in plus, and the 17,000 is in minus. After calculating, our net transaction is 83,000. It is in plus, so it is net profit as per financial account. If there is minus, we should write down net loss as per financial account. Dear students, after watching the video, if you like this video, make black like button into blue. If you have any confusion, you should write down on comment box, and do not forget to subscribe this channel.